The exchange, everybody. Buybacks. Some consider it a dirty word, and they're front of mind this week as the White House slams Chevron's plan to buy back $75 billion of its own shares amid record profits for the oil industry. That got us thinking, when are buybacks a signal to buy, and when are they a signal to bail? Let's welcome in CNBC contributor Gina Sanchez to answer that question. She's chief market strategist at Lido Advisors. Good to see you again, Gina. Welcome.
Thank you, Kelly.
Let's start with Walmart. That was our mystery chart. It announced a $20 billion share buyback in November. It lifted its sales and profit forecast. They benefit from cost cutting and high inflation and recession fears. Shares are up 13%. And you think this is a buyback that people should invest in accordingly?
Yes, and remember, we're investing despite the buyback. So really what we're looking at is companies that have, the potential to make it through the recession, and Walmart is one of those. As people belt tighten, as households belt tighten, people start, they stop shopping at the better, at the higher priced stores, and they go to Walmart. This is a place where you can get it a lot for very little, and that's going to be the name of the game for the next 6 months. And the expectations for revenue growth at Walmart are quite high. They've been giving very, very conservative guidance, but we actually think that there is some upside to this stock.
Okay, so why are you saying in spite of the buybacks? And I'll ask you the question as we move on to Costco, Gina. Another great company, executed well over time. They just reauthorized a $4 billion buyback last week, replacing the current one. It did about $1.5 billion repurchase. Shares are up nearly 10% to start the year. What do you say?
Well, look, we like Costco because, again, this is a cost-cutting story, but this is also a way to get quality in bulk. Costco has actually done very well this past year. The expectations are expecting to moderate, and so they feel maybe a little more highly valued than some of the others. But when companies are buying back, Kelly, they're giving you one of two signals. Either they're trying to inflate their growth numbers, or they just don't have any internal uses for the money, any place to invest it. And so they're saying, here, let me give it back to you. Maybe you can find someplace to use it. And so that's just not a great way. That's not a great signal.
But can't they sometimes say, we think our own shares are undervalued and one of the best investments we can make is buying them back right now?
That's the most optimistic view, Kelly. I leave it to you to be the optimist here. And yes, that is one of the options, is hey, we think that our shares are tremendously undervalued and we're going to go for it. Now, some of that was because there was a lot of cheap money around. So it was very inexpensive to just borrow money and buy your shares back and make the spread. That was a great plan for a lot of companies, and they did that for a long time. That's going away. So in some ways, buybacks have a higher hurdle. So maybe if that's the idea, then this could be an interesting signal.
Yeah, I mean, Berkshire, they talk about, buying back shares if they get to that level. So, it's kind of got the Warren Buffett stamp of approval. What about Procter Gamble, though, Gina? I saw that look. They announced plans to buy back up to $8 billion in shares fiscal 2023. So that's a pretty sizable move as well.
Yeah, well, Procter Gamble, look, this is a set of products that everybody needs. Everybody has to take a bath. Everybody has to wash the dishes. Everybody has to go to the toilet. I mean, these are basic needs. And, the valuation on Procter Gamble is actually, attractive. And the thing is that these quality types of companies, defensive quality companies, they're only getting more expensive. This past month, we had a rally, and the rally was all value and GARP stocks. And so people want defensive, they want quality, and this is a name that lands in that category.
All right, so those are three names with buybacks. You think, despite that, people can still feel comfortable investing, but Meta is your bail today. It's the poster child for you. They spent $45 billion on buybacks in 2021. Shares plummeted 64% last year for its worst year ever. What does that tell you?
Look, I mean, they may think that their stock is cheap. It went from 70 times forward earnings to, 17 times forward earnings. So, yeah, or 14 times, I think, is where it's at now. That does look cheap. That could also be called a falling knife. And if Procter & Gamble is kind of a necessary buy, we think Facebook and Meta right now are an unnecessary buy. They're changing their whole business model, the core business, which is ad sales. I mean, that whole space has had a really rough year, and it's not expected to get any better next year. And, the metaverse, well, what is that? We don't know what that product is yet. The product's not there yet. So it's really hard to value what the sales can be against that. So, it's kind of unnecessary.